Hi, I'm James Nelson, partner at Massey Knackle Realty Services, and I'm here to bring you the April 2014 Nelson podcast. And in this month's blog, I talk about are 1031 tax-free exchanges in danger? And recently, the Department of Treasury came out with a 297-page 2015 fiscal budget, and buried in it was a proposal to virtually eliminate 1031 tax-free exchanges. They would cap the amount that you can exchange to only $1 million, and then they would index it according to inflation. This would have a major negative impact on the real estate industry. Real estate investors and real estate brokers alike rely on this, and it really propels our market. In fact, in the last 20 transactions that I've closed, half of them involved a 1031 exchange. Now, the way the exchange works is that if you sell investment property, after you close, you have up to 45 days to identify up to 3 properties. Those 45 days take place within 180 days, whereupon you need to close. You can also do a reverse exchange with the same time frame. Now, the CPA firm Shanholt, Glassman, Klein, and Kramer did a memo talking about the Obama administration's proposal and why they are looking to limit the 1031 exchange. And they said, well, this is something that's been around for decades, and it was really to deal with complex transactions where it was difficult to value that necessitated the need to have a qualified intermediary. They're now saying these exchanges are becoming commonplace. But more importantly, what they're saying is that a lot of these exchanges end up going out in perpetuity, where one investor will sell a property, exchange into another, sell that, exchange into another, so ultimately the capital gains are not collected. Forbes estimated that the tax windfall on this could be $18 billion over the next 10 years, but I think what everyone is forgetting is that whenever taxes are raised or something like this is revised, is that the amount of investment activity curtails substantially. And we saw this back in 1991 with the Cuomo tax, when they implemented a 10% state tax. As a result, investment activity plunged and tax collections actually decreased. So that's one thing, but I think the greater concern is that these 1031s often motivate these sellers to buy more expensive properties. It allows them to invest more equity, take on more debt. Ultimately, that's going to create more tax revenue, because these properties are going to be improved. There's going to be more real estate tax revenue, and ultimately more ordinary income. So fortunately, the tax partner from Shanholt, Sandy Klein, said that he thinks this is a long shot. And if you look at Congress's House and Ways Committee, they're already countering this, and they're actually looking for ways that you can facilitate even more investment activity. And they're saying that maybe they could expand exchanges to allow foreigners to exchange into the U.S., but not vice versa. So that would be a proactive step, and let's hope it goes that direction and not the opposite. That's it for this month. Thank you.